gold had a run of around 600% in the bull market of the 70s, right into the 80 high. Here we had another bull run starting in, let's say, '01 to 2010 to 2011. So basically a 10-year bull market around 600%. Let's just say that from the low of the cycle here, we do a 600% move on gold. How far of a move does that take us? And we could really go up. I mean, it's pretty remarkable how high this could take us. But keep in mind, the last bull market was approximately 10 years. So we're talking about from 2000. Well, yeah, I mean, that was in 2016 was the low. So we could be talking about, I know this sounds crazy, but 6,500 on gold in 2026, 2027. I think that's a possibility. Incredible gains if it does go there. That would be a 3x from here about.
Market analysts and industry experts present optimistic forecasts for precious metals, particularly for gold and silver's potential performance through 2025 and beyond. Gareth Soloway, president and CFO of InTheMoneyStocks.com, draws parallels between historical bull markets and current trends, suggesting significant growth potential for gold. According to Soloway's analysis, gold's historical performance, including the 600% gains witnessed in the 1970s and 2001 to 2011 periods, indicates that prices could reach $6,500 by 2026 and 2027 when projected from the 2016 low. While these projections are ambitious, they align with historical patterns during extended bull market periods. The Kitco News Top Metals 2025 survey reveals strong confidence among retail traders in gold's performance, particularly in uncertain market conditions. Of the surveyed retail traders, 51% expect gold to lead metal performance in 2025, while 36% favor silver and 8% anticipate copper taking the lead. Wall Street's perspective generally aligns with this optimistic outlook, though many institutional analysts suggest silver may ultimately outperform gold. According to market experts, silver's outlook presents a more nuanced picture. Soloway notes that while silver's increasing industrial applications add complexity to its market dynamics, near-term targets remain focused on breaking the $35 resistance level. A rise to $50 within the next 2 years appears possible, influenced by inflation and mining costs, though projections of $250 remain distant under current market conditions. Heraeus precious metals analysts reinforce this positive outlook for silver, predicting it will outperform gold in 2025. Their analysis highlights that the current gold-to-silver ratio indicates silver remains historically undervalued compared to gold despite recent strong performance in the sector. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If you look at gold, for instance, I mean, sure, gold has made a new all-time high recently. It's actually having a phenomenal day today, again, pushing up. But if you look and match it up with inflation, gold is not up that much. And I continue to be a very big fan of gold over the longer term, right? Near term, we've seen some chop here, so it could go up a little, could come down a little. But what we are creating on the gold chart is what we would call a wedge pattern. And if this wedge pattern breaks out, we should go right back to the highs. And I have a projected target over 3,000 in 2025 this year on gold. So I still think there's upside there. And you're absolutely right. You have to look at it in terms of inflation to get a real clear reading on how expensive is gold, for instance. And I think that's partially to do with the fact that so much money has come into the stock market, for instance. We've seen trillions and trillions of inflows. And so the idea being is that you have two assets that you could arguably say are kind of lower risk or risk off. One is Bitcoin, which at this stage of its career is not really risk-free. It goes down when the stock market goes down. The only other alternative is really gold. And I think if you just took 10% of the money that's in the stock market right now and you subtracted that and people went to the safe haven of gold, you would easily be well above $3,000 an ounce on gold. And again, for me, I look at inflation as being more like what we saw in the 70s, where you have these pullbacks, then the tightening gets loosened, and then you have a resurgence of inflation. And we kind of have seen that recently with the PPI, CPI, and PCE data, where we started to see an uptick in inflation as well. And so if we're going to see that type of situation, then you're going to have 3% or greater inflation for the next, let's say, 5 to 10 years. Then you're looking at gold being quite the play as an alternative to the US dollar. So we'll take a couple different levels here. So let's start with the chart here. A couple things that I like to do. Number one is I look at past cycles, right? So again, being a data-driven investor or trader, we don't just want to say, oh, I think like you go out there, it's just some gold bugs. They'll be like 10,000, like or with Bitcoin, right? Oh, $1 million on Bitcoin. That really does us no good because it's not based on any fundamental factors. But what we can see is that if we look back here, and this would be the most bullish case over the next 5 or 10 years, is that gold had a run of around 600% in the bull market of the 70s, right into the 80 high. Here we had another bull run starting in, let's say, 01 to 2010 to 2011. So basically a 10-year bull market around 600%. So if we just use that data, right, and we say, okay, let's just say that from the low of the cycle here, we do a 600% move on gold. How far of a move does that take us? And we could really go up. I mean, it's pretty remarkable how high this could take us. But keep in mind, the last bull market was approximately 10 years. So we're talking about from 2000. Well, yeah, I mean, that was in 2016 was the low. So we could be talking about, I know this sounds crazy, but 6,500 on gold in 2026, 2027. I think that's a possibility. Incredible gains if it does go there. That would be a 3x from here about. Let's bring up silver and take a look. I know a lot of people love their silver. I've kind of become a little bit less enamored with silver only because it's become more and more industrialized, where it seems to be favoring that industrial side. So we can see it, even though it had a run, it never got close to its 2011 highs. I think it was, let me just go with the weekly chart. Yeah, that was back in 2011 when it got to $50. I still think eventually it goes there because inflation will have to, you'll see costs go up and therefore the price of silver to mine will have to go up. But it's much of a trickier path than gold. So for me, I'm still thinking there's more downside. You have this trend line downsloping here. I'm looking for a move to about 27 to 27.50. And then I think it starts to grind higher. The key for us is we need to see that former $35 level get taken out. Once that gets taken out, then I do think we head up to 50. But, a lot of people out there calling for $250 an ounce. That's a long way away, in my humble opinion. I think 50 is maybe a year away or so, maybe a year and a half away, but that bigger target is much, much further out.
Recent economic data and the upcoming presidential transition create a complex market environment that warrants careful analysis. The December jobs report delivered unexpectedly strong results, with the U.S. economy adding 256,000 positions, significantly exceeding economists' projections of 160,000 jobs. The unemployment rate showed improvement, declining to 4.1% from 4.2%. Market analyst Gareth Soloway emphasizes the significance of the weeks leading up to Donald Trump's inauguration on January 20th, highlighting several critical factors that will influence market dynamics. These include implementing new tariff policies, forthcoming inflation data, and continued monitoring of employment trends. The robust employment figures recorded in the final month of the Biden administration have complicated the Federal Reserve's decision-making process regarding interest rate adjustments. Adding to this complexity, the University of Michigan's Consumer Sentiment Survey revealed elevated inflation expectations, with consumers anticipating a 3.3% price increase over the coming year, a notable uptick from previous months. Federal Reserve officials have adjusted their economic projections for the incoming administration's proposed policies. These considerations include the potential impact of expanded import tariffs, tax reduction measures, and immigration policy changes. Let's get back to the interview.
I think the biggest thing that I'm watching for, and this will take us probably to our next interview, maybe in a month and a half, 2 months, is that we're going to have the inauguration of Trump. I want to see what the tariffs are. How does that impact the markets? I want to see the next PPI and CPI numbers for inflation, and obviously coming up the jobs data. And those will really shape how the economy is. Do interest rates continue to push towards 5% and ultimately shape the markets? Now, technically speaking, the stock market looks very, very poor here. So it's favoring that downside move, but maybe, just maybe we can reverse that. So again, this next week or two going into that inauguration, really, really key for the markets. It's something I'll be watching and everyone should watch as well.
What would get you to change your crash forecast?
That's a great question, and I'm going to tell you why. So what's so hard about changing that forecast is that if the U.S. were to cut spending, which is what we have to do to kind of right the ship, it's going to push us into recession, right? There's just, I mean, you can't, there's so much stimulus in that government spending that there's no way to avoid it. So that's what the healthy thing. So if you're asking me, like, what do I think would bring out around the new dawn of a great U.S. economy in 5 or 10 years? So that's kind of along the lines of that crash scenario or big market decline. On the other side, if we saw interest rates falling and the government keeps spending, maybe that can prolong the drugs that are helping keep the market and investors in this bullish mindset. So I would say in the short term, that would kind of take away that downside risk. But the long term would be even worse. I would much rather, at least for me, and I know a lot of your viewers, we've kind of made our bed at this point. We kind of have to lay in it. And it could be tough for a little while, but then I think we emerge afterwards much, much healthier. S&P 500. So I think one of the last times we talked, we were right up here in early December, and we were right into a cycle date, and it was this longer term trend line of resistance. And what we could see that since then we had the big drop and then a lot of sideways chop. It actually has created a head and shoulders pattern, which is a technical bearish head setup here. So just to show you guys, here's your left shoulder, your head, and your right shoulder. And the idea being is that this is a bearish pattern. When it breaks here, you're going to get another leg down in the S&P 500. So that's just the S&P 500. The other thing I want to show you guys is this is what I can continue to be really concerned about, is that if we flip over to the logarithmic chart, and we go back a long way. Now, the general rule in technical analysis is the further back you go in history, if you can find a trend line and it goes back, let's say 10 years, 20 years, it has more staying power because of that. It's like someone who's been like the greatest baseball player for a long period of time. It's just like, wow, you got to respect that. So what we have here, if we go back to 1929 on the S&P, which is just before the Great Depression, and we take that high and we connect it through the high of the dot-com bubble using the logarithmic chart, look at what we get. We get this high on the S&P. And that's concerning to me because it's not like a trend line that goes back a month. This is a trend line that goes back almost 100 years on the log chart. So that's number one. The second thing is the confluence of this. And that's with the NASDAQ chart here. If we go to the NASDAQ composite, there is a parallel. It doesn't go back quite as far, but it goes back to the COVID low. All right, let me flip off my log chart so we get back to regular. So here's your low from COVID and your low from the bear market of 2022. You take that parallel, which is right here. So we basically drew that trend line in, we stretch a parallel up and look at what we get. The bull market high. And what did we just tag right over here on the NASDAQ? The high recently. And so the extrapolation is essentially saying, okay, we're seeing on multi-decade, 100-year charts, multi-year charts, that we have just tagged these major points that correspond with major points historically. We have to start prepping that we could be in another bubble and we could see a 30, 40, 50% correction. And listen, let's be fair. It doesn't mean it has to happen tomorrow or next week or next month, but over the next couple of years, we could be setting up for a big correction.
The evolving economic landscape, marked by shifting policies and industrial innovation, highlights the transformative potential of precious metals in the years ahead. Gold and silver remain at the forefront, offering a blend of historical reliability and modern relevance as safe haven assets and industrial commodities. What key factors will drive the divergence or convergence in gold and silver's market performance over the next few years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.